Beef, gas, used cars, new cars, dishwashers, bacon, milk. It seems like the cost of everything in America is skyrocketing over the last year, and no doubt if you're a US consumer, when you go to the grocery store, the electronics store, or the gas station, you have definitely noticed that you are paying more for goods and services today than you were a year ago. These inflationary pressures have many people in America concerned that we're entering another 1970s style period of long-run persistent inflation. For those of you that aren't aware, back in the 1970s, the US experienced years and years and years of persistent red-hot inflation that eroded the value of the dollar and left many people much poorer than they were the decade before. As a result of this concern, many of you are looking at buying real estate or potentially cryptocurrency as safe havens that could protect you from this inflation. But what many people don't realize is that the short-term inflationary pressures America is feeling right now could actually result in a big deflationary crash over the next 6 to 12 months that leave the stock market, the housing market, and the crypto market in the gutter. And so I'm putting out this video to help clarify the situation. I'm going to do two principal things. Number one, I'm going to give you guys the historical data on inflation in America so you can see just how bad the current environment is. Number two, I'm going to explain whether this inflation is likely to turn into another 1970s style decade of high inflation, or on the other hand, if it could cause a huge deflationary crash in the economy. You guys have been asking me for this video and I'm glad to finally deliver. This will be great to watch for anyone who's looking to invest in an asset like real estate or cryptocurrency right now, or someone who just wants to learn more about the US economy and inflationary environment in general. Let's get into it, folks. So we're going to start things out by looking at a very simple graph, and what we're evaluating here are the increases in consumer price index, the main measure of inflation that most people refer to in America over the last decade. And you can see that no doubt through September 2021, we have some of the highest levels of consumer price increases that America has seen in the last 10 years, a 5.4% increase year over year as of September 2021. You can see that in the last 10 years, the closest we ever came was 3.8% in 2011. So quite legitimately, the inflationary pressures America is experiencing right now have not been felt in quite some time. And so over the last year, we've seen a 5.4% increase in the prices that consumers pay in America, according to data from the Bureau of Labor Statistics. However, what most people don't realize is that this is just an average number, and that some segments, some goods in the economy have gone way up in price, while other goods have actually gone down in price. Off the bat, you can see that we've had huge increases in prices in anything related to energy. Unleaded gas has gone up by 43% in price year over year. Propane and kerosene have gone up by 27% year over year. Utility gas service has gone up by 20%. And so if you're going to the gas pump, if you're in the Northeast or Midwest and buying heating oil for your home over the winter, you are definitely noticing these increased prices. We've also seen a big increase in perishable foods and meats. For instance, uncooked beef steaks are up 22%. If you guys are enjoying the data in this video and you want to see more of it going forward, just make sure to smash that like button, hit that like button super hard. When you do that, it gets me more exposure on YouTube, allows me to produce more of this content going forward. Bacon and bacon-related products are up 19%. Beef and veal more generally is up 17%. Pork up 12%. So absolutely eye-watering increases in prices related to energy, cars, perishable food items, as well as major appliances. If you're going to buy a dishwasher or refrigerator, expect that there's a shortage of those things and that you're paying way more than you were a year ago. But as I said before, the prices of everything aren't going up. In fact, there are certain goods where prices have gone down. Telephone hardware and calculators are 14% cheaper today than they were a year ago. Audio equipment's 8% cheaper. Prescription drugs are 2% cheaper. Butter is cheaper. Frankfurters, frozen vegetables, cheese, girls' apparel, toys, financial services. And so this is an important point to understand, is that while we're seeing huge inflationary pressures in terms of things like energy and meat and cars and appliances, we're not necessarily seeing those inflationary pressures in all parts of the economy. And in fact, around 2/3 of all the items tracked by the Bureau of Labor Statistics actually fall below the headline 5.4% inflation rate in terms of how much the specific prices have gone up. And I want to be clear about one thing. This doesn't mean that the increases in price in energy and food don't matter. Clearly they do, right? It's a big deal if Americans, particularly poor and middle class Americans, have to go and pay more for food or gasoline. That doesn't make anyone feel good. However, in terms of addressing the question if we're going to see continued long-term persistent inflation like we did in the 1970s, it's very important to understand that the current inflation is not yet broad-based. It's specific to certain goods, certain sectors of the economy, which have had big shortages due to the pandemic reopening. For instance, cars have gone up a lot in price because there's a shortage of semiconductor chips to make those cars. Additionally, the cost of meat has gone up a lot because of labor shortages that inhibit the processing of that meat. The thing to remember about the 1970s and style inflation that everyone's scared about is that that inflation was persistent, high, and brutal across everywhere in the economy. The cost of everything got way more expensive. Not just certain goods where there was a shortage at a given point in time, but everything became more expensive over the course of a decade. And you can see that outlined on this graph where we're looking at the year-over-year increases in consumer prices going back the last 70 years. And no doubt you see the 70s sticks out like a sore thumb. Starting in 1970s, we had like 6% inflation. Then that went to 12% inflation by 1974, all the way up to 15% inflation by 1980. Absolutely crazy levels where the prices of everything were just going up, not just for 6 months, but for a long period of time. Conversely, we can see the levels of price increases in America over the last couple months, while high at around 5.5%, are nothing yet compared to that 1970s style inflation. So the question is this just the start? What we're seeing today in the fall of 2021, is this just the start of another decade-long period of excessive inflation like we just saw in that graph in the 1970s? To answer this question, it's important to understand exactly how inflation works. Inflation is not just a short-term increase in price in a certain sector due to a shortage at a given time. It's all of a sudden prices across the entire economy going up consistently. And there's a specific environment that needs to occur to make that happen. Let me show you what I'm talking about. So the first place we need to start in understanding whether we're in another era of persistent inflation and entering a vicious cycle of inflation is producer prices. This is how much businesses pay for goods in terms of like turning around and manufacturing those goods to sell to you or me as a consumer. Think about how much a restaurant pays to buy food in bulk, or think about how much maybe a furniture maker would pay to buy wood to produce furniture. These are heavily influenced by raw materials costs and commodity costs, and no doubt producer prices have shot up a lot, actually even more than consumer prices over the last year. When producer prices go up a lot, those producers, those businesses will want to pass off those higher prices to consumers. And this is actually the data we've been looking at so far. Consumer prices, how much you and me pay for goods, the finished goods. This is the CPI data, the increase in consumer prices that we've evaluated thus far. However, that is not necessarily persistent long-run inflation. There's another spot on that triangle that needs to be filled out for the inflation genie to really be let out of the bottle. But stop and think about this for a second. If consumer prices just keep going up, aka how much you and me pay for gas or meat or appliances, eventually you and me are going to run out of money. Right? And when we run out of money, we're going to cut back our purchases, and all of a sudden business inventories are going to go up, and then that will lead to lower consumer prices. What you really need for the inflation cycle to continue is not just higher producer and consumer prices, you need then wages to go up in turn. And so after the producer prices cause consumer prices to go up to continue inflation, we then need wages to go up, aka how much you and me earn. This has to go up for inflation to continue, because if it doesn't, like I said a second ago, we're just going to buy fewer goods as a result of higher consumer prices, and that's going to cause business inventories to go up and prices to go back down. We really need wages to go up so we can then afford the higher consumer prices. In turn, higher wages are then going to cause producers to want to increase prices even more, and thus the cycle becomes vicious and long-term. And thus far, wages are not keeping up with inflation. Data from the Bureau of Labor Statistics shows a roughly 4% year-over-year increase in wages over the last couple months, while the increase in inflation has been around 5 to 5.5% year-over-year. This means that Americans are getting poorer. Their wages are not going up enough to keep up with the higher prices that they're paying at the grocery store or the gas station or the electronics store. This is a very negative outcome. It's not good that Americans are poorer than they were 12 months ago. However, the ironic thing is that Americans getting poorer makes it less likely this inflationary cycle will continue, because at some point Americans are going to say to themselves, wait a minute, I don't have enough money left over after buying these goods. I'm going to need to cut back on my spending, especially now that all of the government stimulus is going away. The US government injected $4 trillion into the economy over the last 18 months through PPP loans, stimulus checks, extended unemployment insurance. But now that all of this government stimulus is fading away, the full burden of sustaining demand in this inflationary environment is going to fall on the US job market and US consumers. And so the real question at hand here is, can businesses, number one, continue to pass off these higher producer prices to the consumers? And then number two, do businesses feel confident enough to hire more people and make up for the fact of the 4 to 5 million jobs we've lost since the pandemic? Will businesses rehire those people at the higher wages needed to support the inflation cycle? I'm personally skeptical that that's going to happen, because when you look at the environment in America right now, it does not appear like consumers or businesses are that confident about the future. Take a look at this article real quick, folks, from CNBC titled, U.S. Consumer Confidence Hits 7-Month Low, Goods Trade Deficit Widens. It goes on to say, the survey from the Consumer Conference Board on Tuesday showed consumers less interested in buying a home and big-ticket items such as motor vehicles and major household appliances over the next 6 months. Economic activity has cooled in recent months as the boost from pandemic relief money has faded. Here's the key one, though, folks. These back-to-back declines in consumer confidence suggest consumers have grown more cautious and are likely to curtail spending going forward, said Lynn Franco, Senior Director of Economic Indicators at the Conference Board in Washington. If consumers plan to cut back their spending over the next 6 to 12 months, that's a big problem for the U.S. economy and could cause a major crash. It's also a big problem for the inflation narrative, because if consumers cut back their spending, that means business inventories will increase, which will then cause businesses to decrease prices and thus create a deflationary environment. And the real big issue that I see right now in our inflationary economy is the mismatch we're seeing between producer prices and consumer prices. Right now, we're in an environment where businesses are bearing a much higher brunt of this inflation than consumers are. Let me show you what I'm talking about. So on this graph, we're comparing two lines. The blue line is the year-over-year increase in CPI. This has been the data that we've kind of been referencing throughout this whole video, while the yellow line is the year-over-year increase in producer prices. And so if you think back to that triangle we looked at before, we have producer prices, consumer prices. You can see here that producers are bearing the brunt of the price increases so far. A 20% year-over-year increase in producer prices compared to only a 5.2, 5.4% increase in consumer prices. Ideally, businesses would love to pass these increases off more to consumers than they are currently. However, it seems like producers are having trouble doing that. Think back to the article that we just looked at. Consumers are planning to rein in their spending over the next 6 months, especially on big ticket items such as homes and major appliances. Consumers don't want to spend as much. They're saying these higher prices are going to lead to them spending less. That means producers now are absorbing all of these price increases at the business level, and they're going to have trouble passing them off. Do you guys know what that means? That means a lot of businesses could be shutting down over the next 3, 6, 12 months. Think about what a car dealership is dealing with right now. Since the cost of cars has gone way up, car sales have plummeted down to their lowest levels in 10 years. That means a lot of car dealerships aren't selling enough inventory to sustain themselves. It's very likely that if problem persists, which Americans say it will, we're not planning on spending as much over the next 6 months, a lot of car dealerships might have to lay people off or shut down. Or think about what home builders are facing. New home sales have plummeted over the last 3 to 4 months, just as housing starts have surged. That means we're going to enter an environment in the next half year where all of a sudden there's a lot more new homes on the market, and it's more and more likely that builders are going to have to cut back new construction and lay people off. What's got to make you scared about this relationship between producer and consumer prices is if you go back to 2008. This was the last time this happened, where we saw a massive surge in producer prices corresponding with a more moderate surge in consumer prices, and it was really the gap between the yellow and the blue lines which destabilized the mid-2008 economy and really was the spark plug to the worst recession and worst financial crash that we've ever seen. Could we be entering a similar situation based on the huge gap between producer and consumer prices today? And no one knows for sure what the answer to that question is, but what I do know for sure is that the people who are acting like long-term persistent 1970 style inflation is a guarantee to be experienced in America are off base. They're not looking at the big picture. They don't see the risks that are inherent in America's economy right now and how these short-term inflationary pressures could actually doom the entire economy and lead to job losses, huge inventory spikes, cuts in prices, and deflation. And to just address real estate and housing market more specifically, folks, home prices today in America are at an all-time high relative to inflation. That means that if you're buying a home today, you almost like need persistent inflation to happen over the next 5 years to justify the price you're paying. As we've established, it's unclear whether that inflation will even come, and even if it does, higher inflation will likely correspond to a rising interest rate environment, which could create its own problems for the housing market, specifically in red-hot Sunbelt metros like Tampa, Austin, Phoenix, Vegas, or Dallas, where home prices are just way above local wages and inflation. Higher interest rates could doom those markets, even if we are in an inflationary environment. All right, everyone, I hope you guys enjoyed this video. Inflation's a very kind of personal, emotional issue, and no one likes to pay higher prices. However, I think we need to be objective in terms of analyzing whether long-term inflation is truly here to stay. If you guys enjoyed this video, make sure you've smashed that like button to oblivion so far. Just don't undo your previous like if you already liked it. In addition, make sure you're a subscriber to the channel. I come out with 3 of these data-driven videos on the housing market and economy per week. Also think about joining the channel as a sponsor member. The cost is $5 a month, and you get some really cool perks, namely a monthly newsletter that's exclusive to channel member that has all types of data on the US housing market, including inflation and wages on a market-by-market basis, something that you really need to track and see how much wages are going up in your city to see if they support and justify home prices. If you're interested in this monthly newsletter, the last issue came out about a week ago, make sure to hit the join button below and become a ReVenture channel sponsor. All right, everyone, until next time, this is Nick from ReVenture Consulting, signing off.